whole journey of crypto since 2012, 2013, I knew that next time we hit a recession, crypto and macro were going to merge because the solution and the problems were all about to hit the road at the same point. And when that happened in March, I've been already kind of ramping up my my knowledge curve into crypto again. Just before that, trying to figure out, okay, when did I want to get in again? The event happened. It was like, okay, this is the once in a lifetime opportunity. And that was that.
So Raoul, you took a massive swing at crypto at the same time like gold bulls were feverish, and they gave you a lot of crap for it in the legacy market for taking a really aggressive and I'd say progressive position on Bitcoin being a higher beta play on the same idea. Can you expound on like why you made that decision and what gave you the conviction for it?
When I got started kind of March, I was short equity markets, betting they were going to go down. I'd started buying Bitcoin, I bought gold, and I was long bonds, expecting rates to go to zero, which is essentially all played out. So it was an amazing period of time. Then we kind of settled in the trade. I closed out my short positions in equities because they're always dangerous when the central bank's printing unprecedented amounts of money. And I thought, okay, if they're printing unprecedented amounts of money, how do you capture that? You know, what's the trade to be done? And the trade was this debasement of currency and the kind of people wanting to protect their capital. So I was still with gold and Bitcoin, and basically I just started toying around with the charts of Bitcoin versus ... and looked at anything. And it was like, well, it's actually outperforming everything on Earth. And at the time it hadn't started fully outperforming for this cycle, the central bank balance sheets. But other than that, it was starting to break down versus gold, equities, NASDAQ, you know, copper, I mean, you name it. And I was like, I called it the supermassive black hole, that I saw that it had a high probability of outperforming literally every asset on Earth, and therefore it was going to suck in all the capital. And so I just closed my gold position, went 100% into Bitcoin at that point, and then eventually broadened out into other digital assets.
Yeah, I think that one of the things that interests me there is a lot of people from legacy markets, been around a long time, they saw Bitcoin explode from 0 to 20K, and they're like, all right, this is game over. And, you know, it was one of those once in a generation type bubbles, and then off you go to the next thing. And some people stuck around and are like, no, this is going to still play a role in the macro landscape the next time that this is an appropriate trade. What gave you the conviction to fade the like tulip concept versus the like this is going to stick around and be a part of real macro?
So I'd written in 2013 an article about stock to flow. So I kind of thought, well, if Bitcoin is digital gold, then it should have the same attributes. So I kind of figured out on a rough kind of back of a fag packet piece, calculation is, okay, how much gold is above ground? How much gets mined? How much do we know is in discoverable sources below the earth? And then kind of back that out into Bitcoin. And I figured out with gold at the time is about 1,500. Bitcoin should be at 1 million. And that was, I thought, okay. So, and it was at the time, it was at 200 or something stupid. So I'm like, okay, this is the wrong price. So that was the start. I probably wrote the first ever article about kind of macro valuation of Bitcoin. Then obviously Plan B independently and brilliantly put together his stock to flow model, which even if it's not 100% perfect, gives us a conceptualization of how this might work because of this halving and the scarcity of the asset. But it was really discovering Metcalfe's law and how it applied to networks that gave me an understanding of how big this really could be. And once you look at things that are network adoption models, you tend to find they don't mean revert like a commodity that tends to have, not enough supply, which is going on right now. Supply meets it, collapses, right? This can't happen in crypto just by definition, particularly in Bitcoin. And then when you look at it, all of these kind of events, they look like bubbles, but they're all part of an exponential trend. So once you put it in a logarithmic chart, it actually looks pretty normal. And that's how you have to get your head around it. And humans don't think in non-linear terms. It's really hard for us. So, if you take 20 linear steps out of my office here, I get to the other side of the lounge. If I take 20 exponential steps, I go around the world twice or something stupid. So, we can't get our heads around this. But I started looking at those charts, figuring out how network effects apply to this, and then realized the only mean reversion is probably to something like the 3 or 5 year exponential moving average, and that's it. So it's just an exponential curve that keeps going but flattens out over time as the network effects get more saturated.
Yeah, I like that. Kobe, I can keep going unless you want to butt in.
Take it away, mate. Take it away.
So the next critique that you got from the world was because, the Bitcoiners all embraced you on that, right? And then you were like, well, ETH looks pretty cool. And you had some guests on Real Vision that were talking about different crypto assets. So if you're talking about Metcalfe's law and stock to flow and all this Bitcoin stuff, it's a black hole. How do you then choose to diversify into other crypto assets? And
I mean,
is it a hedge or what?
I talked a long time about the tokenization of the world, so I kind of got the whole concept. But Bitcoin was the pure play for the economic situation we were in, right? Made the total sense, right? Easiest narrative, first port of call, lowest down the risk curve. So that made sense. But as the rally started broadening out, we know that over time people move further out the risk curve. The next one out the risk curve is Ethereum, and then you can go all the way out to some brand new protocol that nobody knows whether it's going to work or not. Or
Coinbase just listed a coin called Shiba, so
yeah, exactly. So it could be Shiba, right? So people go out the risk curve, and that's normal, right? It happens in all financial markets. So I figured that was going to happen because that's how people do things. And at the same time, I'd started looking at the chart of Ethereum and thought, this is a really great chart. So I started writing about it, and particularly the ETH Bitcoin cross. So I started writing about it a bit, and hilarious. I mean, I write about it in Global Macro Investor, and they're all kind of institutional guys, hedge fund guys. They're all like, oh, that's fascinating. I put it on Twitter, and was like, how
system
dare
we have
you?
is pretty
You're
good.
cheating on us. I'm like,
But
what?
everything we
and
buy
then
today
I started
has to
getting
go
called a
through a bank or
shitcoiner
credit
and a
card company
spammer.
who take a cut of
I'm
the
like,
transaction.
wow, if somebody tells me not to do something, I'm absolutely going to go and do it. So I started doing the homework on it. And the argument was that John Pfeffer's article about why all coins go to zero except Bitcoin, I just thought, well, this is bullshit. So I went and disproved it and wrote an article about it. And he built this model around some sort of quantity theory of money model, and it's like, it's never worked in the real world, so why is it going to work in crypto? And why suddenly do you say in that whole article, which is a great piece, to be honest, but one of the things was, well, obviously Bitcoin has network effects, but nothing else does. And therefore these utility tokens go to zero. I'm like, let me check on that. So I just plotted them out. In fact, to be true, Remy plotted them out because he's better at Excel spreadsheets than I am. And he plotted them out. And guess what? You put on the number of wallets and the price, and lo and behold, there's a nice regression. They're basically to do with network effects. And then I looked at Bitcoin and ETH, and they looked identical, except ETH was earlier. Then I started putting the price of ETH at 5 million wallets and Bitcoin at 5 million wallets. It was exactly the same price, and the price structure was the same. So then I started realizing, well, maybe stock to flow is actually just an extension of Metcalfe's law, and all of this is network effects. So I started then trying to understand more about Metcalfe's law, how it affected the mobile phone industry, the internet, and then stuff like Amazon, Facebook, Google, and all of that. And so that was the huge breakthrough for me, was figuring out all of this, and that ETH was actually gaining faster adoption than Bitcoin.